Two people can look at the exact same stock market numbers. One of them builds real wealth from it. The other never gets a fair shot. This isn't a story about who's smarter. It's about something Wall Street almost never says out loud.
Here's the standard story. Investing is a science. You build models, you calculate what a company's actually worth, you measure the past to predict the future. Warren Buffett himself will tell you that's true, right up until it isn't. Because the best investors also lean on something you can't put in a spreadsheet: judgment, trust, timing, and who gets believed in the first place. That second half of investing has a much bigger price tag than anyone tells you, and it's about to explain a wealth gap that's lasted 80 years.
Start with the science. A stock's price is supposed to reflect a company's future cash flows, discounted back to today. Feed in the numbers, run the model, get an answer. It's clean, it's repeatable, and business schools teach it like physics. Except two completely different strategies both claim the science backs them up. Value investors hunt for the cheapest companies on paper. Growth investors chase the fastest growing ones, often at prices that look absurd on paper. Both camps have decades of results behind them. Both can't be purely a science. If they were, only one of them would actually work. So what's really deciding the outcome? Warren Buffett gave the game away when he explained buying into Coca-Cola. Forget about share of market, he said. I'm talking about share of mind. Not a spreadsheet number, a feeling about how a brand lives in people's heads. The investor Seth Klarman put it even more bluntly. The science of valuing a company, he said, is almost a commodity these days. The real edge, the art, is knowing which 2 or 3 things about a business actually matter and ignoring the noise around everything else. Here's the uncomfortable part. If investing really were pure cold science, it shouldn't matter who's doing it. A formula doesn't check your last name. But the art side, trust, access, who gets welcomed into the room before the deal is even pitched, that side absolutely does check who you are. Think about how most people actually learn to invest in the first place. Not from a textbook, from a parent, an uncle, a family friend who already had money in the market and made it feel normal. That's not science. That's inherited comfort. And for a very long time, whole communities in this country were systematically kept from ever having that person in the family. So when we look at who's actually been allowed to practice the art of investing in America, the pattern isn't subtle, it isn't random, and it has nothing to do with who understood the numbers better. Let's look at what that gap actually looks like today, in real numbers, from the people whose job is to measure it. According to the Federal Reserve's own survey of consumer finances, 66% of white households in America own stock, one way or another. For Black households, that number is 39%. For Hispanic households, 28%. And when families do own stock, the amounts aren't close. The median white family's holding is around $67,800. The median Hispanic family's holding is about $24,500. The median Black family's holding is $16,500. Here's the number that actually explains the size of the gap. Stock ownership makes up roughly 30% of the average white family's total wealth. For the average Black family, it's about 4%. 4%. That doesn't sound like it should matter much, until you remember the stock market has averaged something like 10% a year for the last 4 decades. Run 30% of your wealth through that engine for 40 years versus 4%, and you don't get a small gap, you get a canyon. Retirement accounts tell the same story. The median white family's retirement account holds around $100,000. The median Hispanic family's holds about $55,600. The median Black family's holds $39,000. Same accounts, same tax rules, wildly different amounts inside them. And that canyon has nothing to do with anyone's intelligence and everything to do with who had 30% to invest in the first place. So where did that starting difference actually come from? A lot of it traces back to one law from one specific year, 1944. The GI Bill was supposed to build the American middle class for anyone who served in World War II. Low-interest home loans, a path into the suburbs, a foothold in exactly the kind of stock-owning, home-owning wealth we've been talking about. On paper, it applied to everyone. In practice, it excluded most of the 1.2 million Black veterans who came home from that war. The VA could co-sign a loan, but it didn't guarantee one. So white-run banks were free to simply refuse Black veterans the mortgages the law had promised them. White veterans flowed into new suburbs and started building equity. Black veterans, overwhelmingly, could not. And it wasn't only home loans. The bill's job training and placement benefits ran through those same segregated local systems. And by most accounts, the majority of the skilled positions that could have built a second income stream went to white veterans instead. Historians and policy researchers, including reporting from NPR and analysis from the policy research group Demos, link that one policy failure directly to a wealth gap that's now estimated at around $11 trillion between white and Black households in America. Not because one group tried harder to invest, because one group was handed the starting capital to try at all, and the other wasn't.
Now, the easy explanation you'll hear for all of this is that it's a financial literacy problem, that people just need to be taught more about investing. The data says otherwise. In a 2022 survey from Ariel Investments and Charles Schwab, Black respondents who'd stopped investing or never started didn't mostly say they didn't understand the stock market. They said they didn't trust it. 36% cited distrust of the stock market itself, compared to 29% of white respondents. 25% cited distrust of financial institutions generally. And that distrust isn't abstract. It's built on real history, from redlining to more recent cases like a major bank opening accounts without customers' consent, or lenders approving Black borrowers at a fraction of the rate of white ones. The same access problem shows up for Latino workers today, only 40% of whom have access to an employer-sponsored retirement plan at all, compared to 63% of white workers, often because they're concentrated in industries that simply don't offer one. You can't invest through a plan you were never offered. This isn't a knowledge gap, it's a trust gap. And trust, unlike a formula, has to be earned back one honest interaction at a time.
And it's not just history. This exact pattern is still running today, in the part of finance that claims to be the most rigorously data-driven of all, venture capital. Just 1% of all venture capital funding goes to Black-founded companies. Latino and Latina founders combined get roughly 1.5%, according to venture funding research reported by Fast Company. Add it up, and it's a gap of around $400 billion a year compared to what those founders would get if funding simply matched the population. Venture capitalists will tell you they're running the numbers, market size, growth rate, unit economics, but somewhere in that process, a huge number of qualified founders get filtered out by something no spreadsheet measures, whether they feel fundable to the person across the table. It's gotten visible enough that California passed a law requiring venture firms to disclose their funding breakdowns by founder demographics, a direct attempt to make that invisible filtering harder to wave away as coincidence. That's the art of investing working exactly backwards. So if the art side of investing built this gap, and it's still building it today, here's the part that should change how you think about all of it. Some of the people who understood that art better than almost anyone on Wall Street used it to build a different kind of firm entirely. Not by accident, and not as charity, but on purpose, as a strategy. Because if the art of investing is what built this gap in the first place, the same art, aimed deliberately, is what can start closing it.
In 1983, a 24-year-old named John Rogers founded Ariel Investments on 3 ideas: patience, focus, and independent thinking. His firm's own logo is a tortoise, a direct bet that slow, deliberate judgment beats fast, confident guessing, decade after decade. His co-CEO, Mellody Hobson, has spent years making the business case for exactly the trust gap we just walked through.
I know why many people in my community steer clear of Wall Street, she said, but the biggest risk of all is not taking one. Her advice isn't to be colorblind, she says, it's to be color brave. She doesn't just say this from the sidelines either. She chairs the board of Starbucks, one of the most visible boardrooms in the country. And Robert F. Smith, who built Vista Equity into one of the largest private equity firms in the world, has put real money behind a plan he calls the 2% solution, asking companies to invest 2% of profits directly into the financial infrastructure of communities the wealth gap left behind. It's the same instinct behind his decision to personally pay off the student debt of an entire graduating class at Morehouse College. Not charity, capital, aimed on purpose at the exact gap we've been describing.
Same country, same market, wildly different access. And this pattern isn't only one story. Research from OASTA, the Native Community Development Network, found that less than 0.5% of philanthropic and investment dollars nationally reach Native-led initiatives, even though every dollar put into a Native community lender is estimated to generate more than $2 in local economic impact. And research from the Urban Institute shows Asian Americans, as a group, have the highest median net worth in the country, but also the widest gap between their richest and poorest families of any group measured. Same country, same market, wildly different access to the art side of the game. So the next time someone tells you investing is just numbers, that it's purely a science, and the market simply rewards whoever's smartest, remember what actually built this gap, and what's slowly closing it. That's true whether we're talking about a law from 1944, a survey from 2022, or a venture capital term sheet signed last month. Not better math. Trust, extended or withheld. Access, given or denied. Money was never built by formulas alone. If this changed how you think about who gets called a natural investor, subscribe. We trace the hidden forces behind money decisions every week.